as REITs gain on Fed's reaffirmation that 3 rate cuts to come this year. Wow, if you are also a fellow REIT shareholder, then this is probably good news, correct? Because if you were to pull up the IHS REIT Leaders Index, you would realize that there was a very sharp bounce just in the last 1 week. Of course, this is still not back to all-time highs, very far away. But again, if you are a REIT shareholder, this is good news, and I guess many of you guys are. If you check our official Telegram group, you would find that this poll has suggested that many are really waiting for REITs to recover, including myself. So if you're also on board, continue watching. Hi guys, welcome back. Let's first start off with this headline that Fed Chairman Powell is ready to support job markets even if it means lingering inflation. Long story short, job markets seem a bit wobbly, and that's why the headline reads like this. But more often than not, interest rate speculation is usually a waste of time. Things change very quickly on the ground, and sometimes these headlines are just there to support another underlying reason which many suspect is just Biden put. With re-election this year, Fed doesn't have the guts to go with very aggressive stance on keeping interest rates high. That could be why traders are pricing 1 in 7 chance of a first rate cut in May, and the majority of them pricing a 70% chance of a rate cut by June. Now, knowing the possible interest rate direction, it's still a little bit useful to guess where the loan costs of REITs are heading towards, correct? Which is something I'll explain in a while. And stay right to the very end because I prepared for you top picks by DBS Research. Now back to this point on Fed cutting interest rates, many are still skeptical. Many still believe that interest rate target at 2% is not going to reach, therefore Fed doesn't have the guts to cut interest rates. That again is speculation, and having said that, Switzerland became the first major economy to cut interest rates in a surprise move. This again is end of March 2024. Question is, will this open the floodgates to more developed economies to cut interest rates? Maybe so, and I think that's what the bond markets are speculating. If you see the US 10-year bond yields, you would realize that it seems to have peaked 6 months back, correct? At around 5%, and right now hovers around 4.2% and possibly trending down. And on this point, it also means that the upcoming April SSB, Singapore Savings Bond issue, is likely around 3%. It won't go a lot higher. And if you are keen to find out, check out links above on Singapore Savings Bond tutorials. Getting back to the point on REITs, the reason this sector came crashing down is because loans started to become more expensive, correct? You know, REITs, they always have 40% thereabouts borrowed. They don't repay these loans some more, which means they keep rolling interest costs. And when loan rates start to go up, it eats into the profits, which also eats into the dividends per unit DPU. This has caused a dividend cut cycle in many REITs, which has impacted the sentiment. Not just that, when interest rates go up, which means risk-free rates are 3-4%, the usual question is, why should I buy REITs which pay 3-4% also? I'm taking on risk. It doesn't make sense, correct? There's something called a risk premium. And therefore, REITs need to sell down in terms of price to reflect that risk premium. If you don't believe dividend yield for REITs could be as low as 3%, you can always check out Parkway Life REIT just a couple of years ago. REITs is something I've covered extensively on Georgetown Finance Summit. If you're keen to learn a bit more on REIT investing and retirement planning, check out my links below to purchase the online access where you can view at your own convenience. We had 2 days of full attendees, whereby 100 people came down and learned a bit better on REIT investing. As always, look for links below, and let's get back to the discussion. Now, all this is in the rear view mirror already. What we need to focus on is refinancing costs firstly for REITs, correct? And I prepared some important information. As always, smash the like button, smash the subscribe, especially if you appreciate research like this helps you understand the markets a bit better. This actually is in Escort Trust refinancing. What I'd like to draw attention is their latest refinancing in March 2024 is only at 3.69% for a 5-year bond. 3.69 seems actually pretty low in my opinion. If we compare that to a bond that they issued 6 months ago, you would realize that they had to pay 4.223%. You see this being reflected again in the previous US 10-year Treasury chart. 6 months ago, it was more expensive. Today, it's cheaper. That begs the question, is loan cost going to peak or not? If it is, maybe that's really finally good news. And therefore, if we see in terms of the 1 week performance for REITs, you would realize it's a sea of green. On the top are some US office REITs, Manulife US REIT, Keppel Pacific Oat US REIT. For these, I've mentioned many times on channel, I'm not really sure what the demand is for US offices, so I guess these are highly speculative. Personally, I'm into the blue chip ones, which include Escort Trust getting 3.3% last 1 week, Ascendas REIT, CICT, Mapletree Logistics Trust, Mapletree Industrial Trust, and Fraser Centrepoint Trust. You would see that these sponsors are very blue chip, many of which have some backing from Temasek in one way or another. They are the ones that will impact the S-REIT Leaders Index as the biggest weightage, and therefore if I were to pull up back the 1 year and the 5 year chart, my hope is that these blue chip REITs will pull the overall index past the 1,200 point range. Currently is at 1,050. If it pulls the index back up above 1,200, on the chart, it does really seem that the bottom could really have been formed. Fingers crossed again, when it gets there, as always, I will do a review with you, and as always, smash the subscribe to stay tuned for it. Now, since you stuck me right at the very end, let me share with you some interesting DBS research insights. What they have mentioned is stick to REITs as Fed pivots. In their recommendation list, you would see that their preferred picks include FCT, Fraser Centrepoint Trust, Landlease REIT, CICT, Capital Land Escort Trust, and 3 industrial trust players. They believe that retail is better than offices, which is better than hotels, and better than industrials. Personally, I like retail, I like hotels a lot, but I'm still glad to hear that they are pretty bullish about current valuations. Landlease REIT is one that I think is very cheap right now. Price to book value is 0.6 times, but I think there's a bit more risk in terms of their debt profile. Over there is mentioned net DE, which is debt to equity, is 0.4 times. That is too big a rounding point. It doesn't really show the amount of debt they have, and therefore it's not a REIT that I've purchased myself. Most recently, I've invested more into Escort Trust, and I'm happy to see that the 12-month target return price for Escort Trust is 1.3 at a 44% upside. That is interesting to note, but also draw your attention to the first name on the list, Fraser Centrepoint Trust, with a target price of $2.70, representing a 23% upside. Fraser Centrepoint Trust has recently been included into the STI index, and if you're keen to find out a full tutorial of it, check out this previous video I had, and I'll see you there too. Take care as always, goodbye.